Should you invest in Roth or traditional? Which one is better for achieving financial independence? I get a lot of questions about this from the comment section and email, and you can submit your question on my website at firesightchat.com. Here are the 5 things that I consider when choosing between Roth and traditional. So the first thing I consider is my current and future tax rates. What you want to look at is your current marginal tax rate and your future marginal tax rate. And the simple answer is that if you think your tax rate will be higher in the future, then making the Roth contributions makes more sense while the federal tax rates are still at a historical low. If your tax rate is going to be lower in retirement, then the traditional contributions might make more sense to you. So essentially, you have to ask yourself if you're going to make more money in retirement than you are now, or if you're going to make less money in retirement than you're making now with a 9-to-5 job. What you should do, what you should also keep in mind, is that starting in 2026, the Tax Cuts and Jobs Act will expire, and the federal income tax rates will go back to the pre-2018 rates. So historically speaking, we're all paying the lowest federal tax rates possible right now. So let me show you the comparison charts between the tax rates now and the tax rates potentially starting in 2026. And take a look at the 2017 federal income tax rates before Trump's tax rates took effect in 2018. We were paying at 10%, 15%, 25, 28, 33, 35, and 39.6%. From 2018 to 2025, we're paying at 10, 12, 22, 24, 32, 35, and 37%. So with the Tax Cuts and Jobs Act expiring at the end of 2025, I haven't heard or seen any new legislation to continue the tax cuts going into 2026. Knowing how Congress operates, it's probably going to happen at the last minute in 2024 or 2025. If I had to take a wild guess, the tax issues will probably be brought up during the election season in 2024. So we'll see what happens if we're going to end up paying more taxes starting in 2026. And why does this matter to you? Because it's going to affect especially middle and high income households. So if you're making less than $41,000 a year as a single person or $84,000 as a married couple, your tax rate is only a difference of $1,200 based on the 2022 federal income tax bracket. And obviously those numbers will increase with inflation over the years. If you're making over $42,000 a year as a single person or $84,000 as a married couple, then your tax rate will increase by 3%. And if you make more than $90,000 a year or $180,000 a year, then your tax rate will increase from 24% to 28%. So you need to keep the federal tax rates in mind when the year 2026 comes, because to me, Roth contributions are much more attractive today because I'm already paying at a lower tax rate with the Tax Cuts and Jobs Act. And I've been either contributing directly to the Roth IRA or doing the backdoor Roth IRA since 2017. And the next thing I consider is what type of FIRE I'm pursuing. If I continue to pursue Fat FIRE at $3.7 million, my tax rates could be a lot higher during my early retirement than now when I'm working, right? So I'd rather pay taxes now so that I can lower my taxable income when I achieve Fat FIRE at $3.7 million. My ultimate strategy is to reduce my taxable FIRE income, and you can check out this video on how I plan to save money on taxes during my early retirement, and I'll put that link in the description below. Now, if I decide to pursue lean FIRE instead at $1.2 million, then I would probably consider making traditional contributions because my tax rates might be lower during my early retirement than now when I'm working. Let me give you an example. Let's say my marginal tax rate right now is at 24% and my lean FIRE retirement is going to be at 12 or 22% marginal tax rate. Then I would probably consider contributing to traditional accounts to lower my taxable income right now and pay taxes on my retirement income later on. If my marginal tax rate is at 24% and my Fat FIRE retirement is going to be the same at 24% or more at 32%, then I'm probably going to prioritize my Roth investments so I can lower my income during my early retirement. Let me give you some more scenarios. But before that, don't forget to download my financial independence resources for free by visiting firesightchat.com/contact. Another scenario is that you're in your 20s and just getting out of college. Your taxable income in your 20s is most likely under 6 figures in annual income due to inexperience, unless you're in a specialized career field that not many people can do. Let's say your taxable income is $40,000. So for your first $10,275 is 10%, and the next $29,725 is 12%. The effective tax rate will be 13.23%, and your marginal tax rate will be 12%. And I hope this all makes sense to you, because I didn't get it for the longest time when I was in my 20s. I really wish my high school had taught this. So you're likely going to benefit from making Roth contributions because you're essentially paying 12% in marginal tax rate now, because your income is likely going to increase over the years, because the next bracket puts you in the 22% tax bracket. That's a big jump between 12 and 22%, right? If you're married and filing your taxes jointly, making less than $83,550 in the year 2022, then you want to take advantage of the Roth contributions for the same situation as a single filer. And for example, the $6,000 I contribute to my Roth IRA and the earnings that comes with it at age 25 will become $185,000 at age 60, and I can withdraw from that completely tax-free. If I add another $6,000 in the following year, that's going to turn into $354,000 at age 60. And if I contribute to my Roth IRA every single year for the next 20 years, I'm looking at $1.7 million tax-free dollars by the time I'm 60 years old. This is not even counting the annual inflation that increases your contributions. So if you had $2 million in your Roth IRA by the time you turn 59.5 with a 4% withdrawal rate, you're looking at $80,000 a year in tax-free income. Wouldn't it be sweet to have $80,000 a year in tax-free income? Look, if I'm ever in doubt between Roth and traditional, I'm going to choose Roth every time, and I'll explain it to you more throughout this video. Another example is your employer offering you the Roth option, like your 401k or TSP. Let's say you're single and your taxable income is $130,000 a year. Your effective tax rate is around 19%, and your marginal tax rate will be 24%. And if you contribute all $20,500 to your traditional 401k or TSP, your marginal tax rate will still be at 24%, saving $5,000 in taxes the same year. And if you don't know whether you'll be in a higher or lower tax bracket by the time you retire, and nobody knows if the government will raise our taxes in the year 2026, then the question comes down to whether you want to pay that $5,000 now or pay that $5,000 later in retirement, assuming that the tax rates remain the same, or pay more in taxes during your retirement if the government decides not to extend the Tax Cuts and Jobs Act in 2026. What you probably didn't know is that you can do a combination of both. You can do $10,000 in traditional 401k and another $10,000 in Roth 401k. It's completely up to you. I know people who do 70% Roth and 30% traditional, or do 80% Roth and 20% traditional. What you should also keep in mind is that you get a 401k match. If you get a 401k match from your employer, that employer portion of the contribution is going directly to your traditional part of the 401k. And if you have a TSP, you get a 5% match that goes directly to the traditional portion of your retirement money. Every one of you has a different financial situation, and there are a lot of strategies with Roth contributions and conversions, and you can check out this video about the Roth IRA conversion strategy, and I'll put the link in the description below. And if you want to talk about your finances, like budget, savings, and investments to achieve your financial independence, you can schedule a free one-on-one 20-minute financial coaching session by visiting firesidechat.com/coaching. And don't forget that I also have a 20% coupon code. If you watched all the way till the end of this video, the coupon code is Geronimo for all paid coaching sessions that will expire on October 31st. So be sure to email me at hello@firesidechat.com or DM me on Instagram at firesidechat. And if you want to know more about how to get started on your financial independence journey, be sure to check out these two videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.